Hello, friends. Welcome to Nirmal Bang. I'm Piyush Jain, and today we are going to be discussing about debt market, about what's happening from the perspective of interest rates, what is happening from the perspective of bond markets. Recently, we heard the news from next year, the Indian sovereign bonds could be getting included in the JP Morgan sovereign bond index. That is something which is very interesting. We'll also try and understand RBI policy event, what that could be implying for you, where are we positioned right now from all the trigger points, inflations, global interest rate hikes, bond yields, movements, a lot of things. And we'll try and navigate perhaps about all of this and simplify that into some couple of very simple perspectives, how perhaps this could imply the debt mutual funds also. And to discuss all of that, we definitely need advice from an industry veteran. And for that, let me now welcome Mr. Mahendra Jajoo, the CIO Fixed Income of Mirae Asset Investment Managers. Mahendraji, welcome to the show.
Thank you. Thank you for inviting me.
So let's start first from the perspective of RBI policy meeting. We saw what happened in July and August. There was a CPI high, consumer price inflation. That number went up. A lot of factors which were attributed to heavy rainfalls that led to sharp sort of food inflation. Recently, we saw fuel price inflation also going up, but nevertheless, pump prices still remain the same. So perhaps that could be a saving grace here. But overall, from a RBI policy event, what do you think RBI would be really looking at? Like more about interest rate hikes outside, or inflation slightly remaining above their comfort level? What would be going on in the minds of the board?
Yeah, so I think in the last couple of months since the last RBI policy, on the global front, we have seen the inflation remaining very sticky and the global bond yields have gone up because the Fed has, effectively guided for higher for longer scenario. That is one part of the inputs as far as the RBI is concerned, but the RBI's monetary policy is largely focused on the domestic factors. And we have seen that in the time since the last policy, the vegetable prices have crashed, the fruit prices have crashed, and therefore there is an expectation that the inflation will possibly get reported somewhere in the 5 to 5 quarter% band in the month of September, and therefore from a high of 7.8, the inflation will have fallen to close to 5% already, and that is a very accelerated correction in the fruits and vegetable prices. That will obviously give comfort to the Reserve Bank, and therefore we expect that the Reserve Bank will continue to maintain the status quo. We do not expect any rate hike in the ensuing policy. However, there are parallel other developments that possibly will need to be acknowledged and factored in. So obviously the recent surge in the global bond yields, yesterday the 10-year yield in US has hit a high of 4.70, which is needless to say the highest since 2007. But I think it is now narrowing the gap between the domestic yield and the international bond market yields. And that is happening at a time where our inflation differentials are narrowing. So if you recall, around the last time, same time last year, the US inflation was much higher than the our inflation. And then in the last 1 year, while their inflation has come down, our inflation has largely remained unchanged, and therefore the gaps have narrowed, and their bond yields have now gone up. So, to the extent that India is a country with a large current account deficit and the need to, balance the capital account with the FIA flows, I think that it's important to acknowledge the recent tightness in the global bond markets, and to that extent, it I think limits the immediate possibility of any rate cut. So therefore, on a net basis, I would think that RBI will remain on pause, but the RBI may guide for being watchful on the recent developments on the global front.
Right, and from that perspective, how sensitive is our own domestic government bond market with respect to any foreign outflows? Because as I understand, the proportion of FPI inflows into the government bond market is not that big.
Yeah, but then when the FPI outflow happens, it can happen from the bond markets, it can happen from the currency markets, it can happen from the equities market. In our equities market, FPI used to be a very big force, and last year in particular, we saw when FPIs were selling in on a massive scale, the resilience of the domestic investors, and driven by the SIP flows, driven by the buying by the mutual funds and by the other financial institutions. In the face of a heavy selling by the FPIs in the last year, our markets held very well, our currency held very well, and domestic liquidity was also well managed by the Reserve Bank. So as I like to say that India is at its resilient best ever that we have seen, and the Reserve Bank with its newfound pragmatic and proactive approach is also backed by the 100 600 billion plus dollar of forex reserve, which it has been using very effectively, has been able to de-link the Indian system to a large extent from the volatility in the uh, global markets. However, if there is a structural shift in the global markets towards a certain direction, I think to the extent that India is now closely linked with the global markets, it is difficult to ignore that, or not ignoring, not acknowledging that is at our own peril. So I think we are in a transition phase right now. Uh, while the Fed has continued to guide for a higher rate, and now they're guiding for a higher rate scenario for a much longer period, the market expectation is still that there could be possibility of a slowdown in the economy in the coming quarters because of the current tightness in the global bond markets. Uh, there are many people who are still expecting recession. In the worst case scenario, people expecting that Fed may not hike the rates further if they may not cut. So there are a lot of equations which are still evolving. The sudden rise in the global oil prices in the last 15 days has also been very threatening. But then we saw that last week itself the oil prices dropped by close to 10%. So there is so much of volatility in the global
Yeah,
markets. There's so much
makes
uncertainty that
makes the task also tough for RBI.
not so much tough, but I think also it makes it tough, but also the Reserve Bank will have to take a view whether these factors are structural in nature or they are transitory factors. So last
Yeah,
time we saw that inflation had shot up to 7.8%, but they were very clear that this is something that they can look through. So I think this is a policy where the Reserve Bank is still possibly yet to decide whether the recent developments are structural in nature or they are transitory
sure.
factors. And to that extent, I think they will get the benefit of the doubt to the market, and they will remain on pause. And therefore, as I said, they will caution us on these factors and to be watchful of these factors. And there will be a possibly indirect comment that if these factors do turn structural in nature, then there may be action required on the part of the Reserve Bank. I don't think this is the policy where we will see any action.
Okay, so rate pause, no hike is actually what is your expectation? I wanted to ask you about the recent JP Morgan Global Index development, but before that, one small question, and that would be, what's your own sort of a growth expectation, economic growth expectation? Because that also perhaps is a very important point when you're really sort of strategizing on debt for this year. How's the sort of growth climate looking to you for this year?
No, growth outlook I think is fairly robust, and there's only one source of drag on the growth, which is the exports. So this month also we saw that exports have fallen, where the imports have held well. So the Indian story is increasingly becoming a domestic consumption story, and the domestic manufacturing pickup. The exports are one area which can drag, but our overall sense is that the growth remains pretty robust. I would say that the Reserve Bank's current projection for the FY24 growth is at 6.5%. I would think that that will remain unchanged because nothing dramatic has happened in the last 6 weeks to either downscale or to upscale the growth projections. Uh, we saw the GST collection numbers for this month over the weekend, and that was about 1.62 trillion, which is about I think 10% plus higher than the same time last year. So
That's
everything is, yeah. So everything is suggesting that the growth momentum remains strong. The capex is picking up. That's another good news. So I would expect the growth projections to remain unchanged in the coming policy.
Well, that's another positive. So if growth remains resilient, there is expectation of a rate pause. Then actually we talk about an interesting development for a debt fund manager like you, and help me understand, like from a layman point of view, from our viewers' point of view, the recent news about that acceptability of the Indian sovereign bonds into the JP Morgan Global Bond Index, starting from June 2024 next year, May June 2024 next year, what that really implies for us, and what amount of funds could be coming, and does that have actually the potential to really move the needle on the bond yields, and like how we should really judge it.
Yeah. So, I mean, to start with, no one can disagree that the impact for the country, for our bond markets, is going to be positive, because if our bonds are going to be part of the global indices, then those people, at least the ones who are the passive investors, will start tracking the index and they will start investing in our bonds. So, to that extent, it is definitely positive. Uh, the most important perspective from our angle is that if JP Morgan has agreed to include the bonds in their index without the government conceding on the tax front, we feel that it is going to be the case that more and more indices will also accept the Indian government bonds. Today, we are in a situation where Russia is going to get out of the most of the indices, and China is increasingly becoming a very wobbly state, and China is also becoming a little bit of a counter-cyclical monetary policy state. When the rest of the world bond yields are going up, China bond yields are going down because the uh, central bank has to support faltering economy. So, and then there are recent challenges in terms of the equation between the developed markets and the China. So, India suddenly becomes a very important player in the bond markets, and therefore it is just not the JP Morgan, but going forward in the next 1 or 2 years, if there is political stability and continuity, then we would expect Barclays or Bloomberg, which are the much larger uh, indices, they may also consider including the government bond. So it's a very positive step. Immediately, we have not found much impact of that because it's going to start from June of 2024. So there is still, almost 9 months to go before the first dollar trickles in. And then JP Morgan Indice is having underlying investor base of about $213 billion. So that would bring in about $21 billion of flows by and large. So let's round it off to $25 billion. Now, putting $25 billion in the perspective, our monthly auctions of the government bonds are somewhere around 15 to 16 billion dollars. So it's not a very large amount compared to the size of our Indian economy. We are now the fifth largest economy in the world, and our government is a reasonably large borrower. We are in the current year going to borrow about 6% of the GDP. So, therefore, I think in terms of immediate impact, there isn't much. And then the positivity of the index inclusion has been overshadowed by the sharp rise in the global bond yields in the current month, and then the inflation story about our domestic market. So I think uh, incrementally the impact is positive. At this point, the amount and the in my view is not very large, uh, and it will come over a longer period of time frame. So no immediate impact, but in the long run, it is definitely positive. There is a flip side to this, obviously, that once you accept the foreign investors then you have to also be accepting them going out. So therefore, our uh, cycles will then get even closely aligned with the global cycles. And then, if you look at a classic case of a market like Indonesia, where the government bond holding of the foreign investors is close to 15%. You see the kind of volatility they have in the bond markets. So that's something that we will have to learn to deal with, because right now the Reserve Bank has a very tight control on the bond markets. But with those players, I think those equations may have to be reshaped.
But then I have a question here, and I'm just thinking from a debt fund manager like you, or a CIO like you, on a debt perspective. Is that suppose if we know that there is an event 1 year down the line, and that, as you just said, it could be a first of its kind, and that could influence other indices to really sort of participate and allow Indian sovereign bonds. So maybe more. But does that also actually become a precursor for the domestic fund managers to take more portions in debt? Because if there is a sort of incoming almost as you said $25 billion over 1 year implies you can say $2 billion per month, and if there is continuous fund flow which could be coming in, can that has a will that have a potential to push the bond yields lower and sort of rally in the bond markets, and also a sort of the domestic money taking a sort of portion in advance?
No, so I think we all saw what happened on the day when the index inclusion was announced. The market opened with a sharp gap up in bond prices, but then by the end of the day, bond prices closed in the negative. So it's a classic case of buy the rumor, sell the fact. I mean, it's a classic, again, saying that market prices in what it knows. Therefore, I think immediate reaction, again, as I said, was also overshadowed by the events in the global market. But impact over the longer term is going to be positive, but the flows have to be meaningful. As of now, what we know is that 213 billion starting from June 24, etc. So every event has two impacts. One is the immediate impact when the news is announced, and then over a longer term. So uh, we have seen that when there is a trend, the first few days of the trend is only about 5% of the total movement. So I think it is too early to start taking a decisive call. But yes, one can expect that in terms of direction it is positive. I also highlighted the other side, that if the foreign investors come in, they can go out also very
Volatility.
soon. So that can lead to volatility. So we have to all learn as things happen as to how to deal with this situation. I
Sure.
would not, yeah.
And so one more question. On the 1 year, maybe 3 to 5 year and 10 year, um, like how the sort of yield curve going to look like? Like where are we right now, and is there any sort of alpha opportunity? Is there anything which you are looking at across all the developments combined into it?
So I think largely the assessment at our end is that the long-term rates have already peaked. So 10-year yield hit 7.6% sometimes last year. And then over the next few months, we have seen so many new developments happen. Oil prices going up and down, US Fed eventually turning out far more hawkish than initially it was assessed, etc. And it has absorbed everything nicely, because today there is a huge demand from the insurance and pension sector, which requires long-term bonds. Therefore, uh, and now the factors which were contributing to inflation has become little bit more supportive. So most of the commodity prices have come down. The oil prices have largely remained range bound. Uh, the other side is that factors which were helping the inflation come down in the last year have now become stable, and most of the commodity prices are showing signs of bottoming out. So we are possibly going into a scenario for the next 6 months where the Reserve Bank will continue to be on pause mode. They'll neither hike nor reduce rate. And in the global environment also, because of the sticky inflation, the Fed may not be in a position to cut rates, whereas at the same time, because they are so far advanced in the rate hike cycle, and the inflation is kind of now threatening to get out of control again, they may not be hiking for too many times, maybe one more time, and then they may stop. There are, some people like who are saying that yields can go to 7% also. So there are other views also in the market from some very, very respected people who got it right at a very early stage. So we have to be mindful of all these things. So I would say that if I today project 6 months to 1 year down the line, I would say the yields are going to be somewhere where they are maybe 25 basis points lower, not too much higher from where they are right now.
Right, and also what in the corporate bond market, how the sort of that part of the market is looking to you, and also from a traditional sort of spread perspective, are we also looking for a sort of rally in corporate bonds?
See, corporate bond spreads had narrowed to a very, low level when the liquidity was good and when the rates were high. But today, if you look at the corporate bond spreads, they're by and large at their long-term average, right? And we are at or close to the peak in the interest rate hike cycle. Therefore, I don't think that the corporate bond spreads are going to widen from here. There is also change in the dynamics of the demand for the corporate bonds with the increasing demand coming from the pension funds, insurance companies, mutual funds, and there are new developments which have happened in the recent time, especially the corporate bond development fund which the SEBI has
Yes,
promoted, and therefore that is, I think, a good reason why there will be no distress in the corporate bond market. We have never had anything like this in the past, and that's going to be operational very soon. And therefore, I would expect that the corporate bond yields will move in line with the government bond yields. So, like I said about the government bond yields, that they're likely to be range bound and likely to remain around the current levels for the next 2 to 3 quarters. I feel the same thing about the corporate bond markets. I don't expect the spreads to blow up or narrow meaningfully from here because the trade pickup is good. Uh, the yield curve is very flat right now, and with the uh, central bank at around close to the rate hike peak, the short term 3 to 5 year corporate bonds are also looking very attractive. So I would say that it's more positively biased than on the negative side at this point in time.
well, we'll take that as a sort of a view where the short-term corporate bonds are looking positive. RBI policy perhaps actually is going to show us a pause, and also developments are looking quite positive from the perspective of sovereign bonds getting included in the global bond indices. So, a couple of positive factors to look forward to, and also then wait for the RBI policy. But for now, Mr. Jaju, thanks a lot for coming on the show and as always, giving us all the insights about the debt market.
Thank you so much once again for inviting me. Thank you.
And dear viewers, hope you enjoyed this conversation. For now, it's a wrap on this conversation.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.